Hi there. In this video, we're looking at Lemonade. We're going to talk about their 5-year blueprint. What the heck am I talking about? I'll get into the details in a moment. Then we're going to talk about, is this blueprint even realistic? I've updated my model to see, can my model realistically fit this 5-year plan? Finally, we're going to talk about what would it mean for Lemonade stock if this 5-year blueprint actually came true. What would it possibly mean for that stock, for Lemonade stock, over the next 5 years and beyond? So let's get into these 3 points. So first off, what is this blueprint? What am I talking about? If we go back to Lemonade's Investor Day presentation from November 2022, you can even watch the video, or you can actually go to the presentation itself. Scroll all the way down to the last final section where it says, Tim Bixby, let's do the numbers. There's a little bit of information here. And then they put this slide up, which is a really interesting slide. They talk about, it's a cash/investment slide. They have $1 billion of cash, and they're projecting out their EBITDA losses but eventually profits coming later in 2027. They're projecting that out over the next 5 years and then showing where their cash actually ends up. Restricted cash, which they have $400 million, which is kind of interesting as well. We'll get to that in a little bit. But also unrestricted, $182 million still of $582 million left when they're turning this sort of profitability quarter and springing forward. But they don't give us any figures, any real details on this chart. But here's where it gets interesting. Aaron Gray, who I met at Investor Day, talked to online here quite a bit. He's a great Lemonade follow. If you want to give him a follow on Twitter at AaronGray9. Aaron Gray tweeted this out the other day. He's basically figured out or roughly measured out what these values could come to. It's just a rough kind of estimate of their estimate, and made 254 boxes on the 1 billion of cash. In other words, 250 billion a box, and then laid the same scaled box over top of the rest of the chart to get a rough idea that probably 2023, we're probably talking about losses of about 190 million, 2024, 170 million, 2025, 125 million, 2026, negative 55 million, and then 100 million positive in the positive direction by 2027 as they flip to profitability. And if you look at these numbers, even if you look at the 182 million here of cash at the end versus this 250 sort of $1 million box, it looks roughly to scale. And I think even his estimates here, I'd say, are pretty close to what you'd be able to estimate by if you measured this really precisely, down to the pixel. So I'm thinking this chart is quite to scale, and we kind of now know what Lemonade, this is the blueprint. Here's sort of Lemonade management's base case for the next 5 years. This is what our guidance could look like. So this is kind of a big deal. So I want to see, can my model fit this? Can my model fit these numbers? Do they even make sense? Are they reasonable? So let's jump over to my model. And this model is available to all my Patreon supporters. If you want to get full access to the model and support the channel, you can join my Patreon. And one important point before we look through some of the numbers and some of the details of this model was that going back to Q4 of last year, if we look at one of the say questions that I asked and that was answered by Shai, I said, what specific ways, so this is Q4 of last year, what specific ways, admin, tech expenses, headcount, etc., are you reducing costs and overhead? How do you plan to reduce costs further and become as efficient as possible? And Shai gave a great answer. He gave a few different points about headcount, about how operating expenses were decreasing, but this line was really, really important line. He said, it's also worth noting that our expense ratio today is built for scale, and we should be able to continue to grow very significantly without matching increasing costs. In other words, they're ready for a massive amount of operating leverage. Operating expenses should be able to remain fairly flat if we take this, as true. Operating expenses should be able to remain fairly flat while the top line metrics should be able to really explode. So with this in mind, let's look at our model over the next 5 years and see if these blueprint numbers are possible. We're not going to look at every single line for every single year. There's also some uncertainty around exactly what the reinsurance will look like. I've roughly left that the same for each year. We'll probably find out more about what the reinsurance, how that might be structured soon. But that's going to be the same for each year as we go forward here. But we're looking at 2023. Here we are right now. We know that the growth is going to be less because they've told us that's going to be less for this year. But I've modeled out a slower amount of customer growth, basically having a minor amount of customers while also having a little bit more premium per customer growth, quarter over quarter, about 1.5%, adding only about $5 a quarter to the PPC. And you get to the end of the year, this is right in line with where they're currently guiding, around $708 million of in-force premium at the end of 2023. Scrolling down, gross loss ratio I have right now at 87% and improving all the way to 80% by the end of the year. So that's just continuing to trend down, which it has been improving each quarter, and you'd think it should continue to improve as more customers bundle more products and become more loyal for that reason, but also they can select, they get more and more data, more refined models, and are able to select customers and renew with the correct customers that are less likely to have a claim. So gross loss ratio should continue to improve for those various reasons. We get down to, this is my sales and marketing, also my customer churn. I calculate into this paragraph or this section right here. So churn from 12 months prior actually have rising a little bit as they push more. I'm assuming they're pushing more into renters insurance sort of temporarily this year. But renters, you might have more customer churn. From that, you get annual dollar retention around 87% and then trending down to 80%, and then it's actually going to go back up later on. But right around that range, then my acquisition cost per customer, $200. I could just keep that across the board, $200 per customer as an average. Actually, the average through the years has been a little bit less than that. This would be net new customers. I mean, include customers who even churned. But anyways, sales and marketing, you get through all that. You have your sales and marketing costs then for the whole year based on the number of customers and that acquisition cost of the customers. Then I have other insurance expenses basically growing at roughly 4% quarter over quarter. It's a smaller operating expense than some of the others, but it is still significant. Tech development, I just have growing at 2%. It actually dropped 7% last quarter. I mean, I know they just did more layoffs in Israel, so this might even have another negative, but I have a 2%, sort of a back in line with Shai's comments. A very small, especially, something like tech development, you think would have a very modest increase or even stay completely flat or even possibly negative while the top line could continue to grow. G&A, I have, again, a small amount of growth, 5%, 2%, 2% on a quarter-over-quarter basis. And you end with about close to $35 million, where last quarter we were $33 million, and last year we were $31 million. So I don't think any of these numbers are too unrealistic. And if you get, I assume, about $15 million a quarter in stock-based compensation, and you calculate, I assume this blueprint is talking about adjusted EBITDA because they're looking at really the cash effects. So that's what I've been going with here. If you look at adjusted EBITDA then for 2023, I'm at $180 to $183 million of the sum of those 4 quarters. That's versus the blueprint, we'll flip back there, about $190 million roughly. I mean, this is just a rough number of approximately $1 billion sort of divided by 4. So that's right in line, close enough, I would say, to say, yes, 2023, very realistic. Might even be at $190 million, might even do better than that over the full year, and hopefully each quarter this year the guidance continues to improve. Now we're going to look at the next 4 years afterwards all at one time, so 2024 all the way to 2027. So biggest change right away, this next year, the current year we're in, I had much lower customer growth and premium per customer growth, but after the years afterwards, I'm expecting that they're going to increase. Customer growth is going to go back to where it's sort of traditionally been before, and premium per customer growth is going to really, really shoot up there as new customers can come on board and buy bigger products than are currently available today, or bundle several products, and existing customers can bundle products. Then we should see premium per customer drive up there pretty rapidly, I would think, over the next few years. So I have basically 4% customer growth, and that translates to, for example, 2024, about 326,000 customers. If we go back even just a few years, like 2022, we had 380,000 new customers. 2021, there was 427,000. So I think this is quite realistic. This year, there's going to be less. I only have 116,000, but then starting the year after, 320-some thousand. And even the year after that, we have closer to 400,000. Continuing to see increased growth there, much larger growth after they take the pause off growth. And premium per customer, I also expect to shoot up like I was just mentioning. So 7% quarter over quarter, where we're going from 368 to 482, all the way up to 582. By the end of 2027, we're at $800 in premium per customer. And that's pretty realistic still, because the national average, I forget offhand, but it's still significantly higher than this, the average insurance customer in the U.S. So because there's always going to have a mix of maybe more renters insurance as they move to new markets, I expect Lemonade's premium per customer will likely tend to be lower, just because you have those younger customers coming on board. But I do think they'll push more into growing with the customers they do have. And of course, new customers can just start off on day one on the bigger ticket items. So this number should move up into this range. Now back to 2024 here. I have, if we look at the gross loss ratio over those next 4 years, I have it from 78% tracking down all the way to 72% by the end of 2027. So again, obviously these numbers are going to bounce up and down. It's not going to be a perfectly smooth line like I'm showing here, but I don't think this is unrealistic to get to 72%. If we look at my customer churn from 12 months prior, again, we were at 21% this quarter. I temporarily going to have it shoot up a little bit just because I think there's going to be more of a push for renters. And then I have it slowly coming down to 20%. Eventually, I think it will go even lower than that. But I think that's still pretty reasonable, 20%. And then you have annual dollar retention of around, in the mid 90% range. And you're spending sales and marketing then about, $50 million a quarter. Again, not too crazy, double what you're spending right now in 2023. But you're adding significantly more customers at that point in time. But you're also churning less customers, so you're losing less money there. Other insurance expenses I have tracking up a little bit higher, about 5% a quarter throughout the years here. We look back on other years in the past. It's been a super lumpy, crazy metric that jumps up and down. So I'm not exactly sure if this specific one's really accurate, but that's what I've input there. Tech development. Again, 1%, 2%, averaged around there. So we get up to, by the end of 2027, we're at about 27 million. While right now, last quarter, we spent about 22 million. In G&A, we're at 32 million right now. Again, punched in some modest growth, 1 or 2% quarter over quarter. End of 2027, we're at $45 million. This is that operating expense or operating leverage that I was talking about based on Shai's comments, that a lot of these numbers there still might increase, but especially should be a fairly slow increase, especially relative to the top line growth that's much, much higher. And your total operating expenses, then you're going from, 90-some million this quarter per quarter right now up to maybe 150-some million by the end of 2027. I also estimated that stock-based compensation continues at about 15 million per quarter. So I've carried that forward through over the next several years. And now let's look. We already looked at 2023, so that was pretty close in adjusted EBITDA. But for 2024, we're at, almost 175 million based on this model. And the blueprint we're looking at was about 170 million for 2024. So really, really close once again. And I don't think this model is unrealistic. The point I'm trying to make here is they're giving us this blueprint, and I really don't think it's unrealistic if you look at these numbers in detail. Now, 2025, we were pretty close there. 2025, we're at 114 million in this model, and 2025, we're at 125 million. So a little bit better than what this graph is showing, but still very close enough for how precise this has to be or could be. And 2026, 32 million. And 2026 here, we're at 55 million. So again, a little bit better than this is showing, but right in line with with the direction of this. And then 2027, we flip to profitability. We're modeling out almost 90 million in profit, and we're at maybe around $100 million in potential profit. Yes, the point I'm trying to make is that management's given us this 5-year plan, and if we look at our numbers carefully and try and fit the model to that plan, I don't think we have to make any crazy assumptions to do that. I think it's very reasonable, very possible that actually this scenario comes true. Of course, none of this is investment advice. Nothing on this channel is. But for me and my analysis and my thinking, I think this is very, very reasonable. This is very, very possible that this could come true. In fact, I think it's probably likely the trend we're seeing right now is we're headed down this path, even in Q1 so far of this year. And the reason we could see this actually coming true is because of the foundation and the foundational qualities of the company. We know that they should be able to become more efficient. They know that they should be able to have massive amount of operating leverage. So the assumptions we made here, the sort of lower operating expense growth relative to the high top line growth, I really think this is very, very possible. We looked at the 5-year blueprint and we talked about, is this realistic? What would it mean for Lemonade stock? What would it mean if this actually happened? Of course, nothing on this channel is investment advice, but here's what I think could potentially happen. It's also really hard to know what valuation the market may give Lemonade if this actually comes true, just because markets give such wildly different valuations depending on macro environments, depending on sentiment at the time. So it's really hard to say what would actually happen. Could be way better than this, could be worse than this. But I've punched in a few numbers here. I've updated a priced to in-force premium ratio, which is typically, I believe, around 1 for most insurers. But for Lemonade, I'm putting in a 4. That's the reason I'm putting in 4, and I think they could be 4x, worth 4 times as much as others insurers could be around 2027. It's just because they're becoming profitable, and also their top line growth is still on a year-over-year basis. In-force premium still growing in the 30% range, and could potentially even go higher than this, or they could be more aggressive in the growth in the years after this. So, and potentially it's such a massive market, they could be growing 30% plus for years and years and years. So that huge upside ahead of them, I think the market would easily give them a 4 times the in-force premium ratio. This could even be really conservative, but I'm putting in 4 for that amount. Also, if we look at a valuation based on a PE ratio, based on the annualized earnings, again, you might think, wow, 150 PE, that's so high. But for a company that's still growing 30-some% year over year and has so much potential growth ahead of them, I don't think these are crazy numbers that the market could give, like, 100 and some X multiple to a company like this that's still so small and could grow to be so huge. So it might even be more than this. Like, it could be, honestly, could be way higher than this number. But I put in 150 or 145 we're showing in 2027. So by the end of 2027, I'm getting maybe a market cap of 8 billion to say 11 billion, something in that range. Of course, Lemonade's market cap right now is 1.26 billion. So 1.26, if we divide, let's just say 10 billion divided by 1.26, you're talking about like an 8x increase over the next 5 years. We punch that in. We're talking like a 52% compound annual growth rate over the next 5 years if you say you got an 8x return. I know this isn't perfect. Even this doesn't account for the dilution we're having, and some of these numbers are so rough. Like, honestly, this number could be like a PE of 500 instead of 145 if the market's just like exuberant for Lemonade. We really don't know. Even if it's something like in the realm of 8x, you're talking about like a 50% or more return per year over the next 5 years. So I would not complain about that if that scenario happened, or even half of that happened. Something I really briefly want to touch on is that for me, it's much more important to know, will something actually happen? Is this actually feasible? rather than the question, when would it be feasible or when would it happen? The bigger question of, is something even possible, or is our model even on the right track at all? That is a much more valuable and important question in my mind. For example, in this scenario, we've made all these assumptions, all these details. We could be right, we could be wrong, but it's much more important to have the backing and the qualitative analysis behind the company that says, yeah, we're moving in the right direction. There's reason to believe all these assumptions could come true, and we could be somewhere in this realm of these numbers 5 years from now. That's much more important than answering, hey, is this going to happen in 5 years or 7 years or 3 years? That is a separate downstream question of the first question, and is much less important whether you have that question right or wrong. The first question, will this actually happen or not, is much more important. And this applies to other investments as well. Great example is Tesla's full self-driving. A lot of people debating, is it going to happen this year? Is it going to happen next year? Is it going to happen in the next 6 months? Is it what's happening? Elon said for the last 4 years it's going to happen every year. I mean, those are all, fine, you can debate those things, but those are downstream questions to what's actually more important is, will Tesla ever achieve full self-driving? That is a much more important question, because even if Tesla does achieve full self-driving, but say it takes till 2030, but they're still the only player who really does it on a fully scalable, generalized way, it doesn't matter. It's still a massive win, massively huge valuation right now, present value for the stock that is probably not accounted for. So that's what I mean. That it's much more important to know, is this even reasonable? Are we on the right track? As opposed to, hey, do I compare these exact numbers and did I nail every quarter perfectly now until 2027? Okay, now that I got that off my chest, I just want to summarize. We have this blueprint. We walk through the model again. You can get this all on my Patreon. I think this is very reasonable. And if this comes true, we might be in the realm of a 50% compound annual return over the next 5 years, or like an 8x. I think something in that world is very reasonable. So thank you so much for watching. Let me know in the comments down below what you thought. You can also find me on Twitter at @PaperBagInvest. And remember, it's in the bag.